Welcome to the Wealth Exchange, your access to the experts addressing the issues affluent families across Canada face every day. From market commentary and planning strategies to leadership and philanthropy, we discuss the subjects that matter to you.
At Nicola Wealth, we specialize in holistic wealth and asset management for accomplished individuals, multi-generational families, institutions, and foundations. In each episode, we aim to provide access to expert insights on a variety of planning topics, market commentary, general education on investing strategies, and on Nicola Wealth's unique approach to building and preserving wealth.
Hello, everyone, and thanks for joining us for our In the Ring with Rob, Nicola Wealth Private Capital podcast. I am Robert Olsen, Vice Chair of Nicola's Private Capital Platform and your host. As background, our private capital business has $3.5 billion of assets under management and is led by a team of over 25 professionals. 2023 was a busy year for us as we reviewed more than 740 transactions totaling over $15 billion of opportunities, invested in 75 of those situations, aggregating approximately $1 billion, and distributed $225 million back to our investors. We've created these podcasts to help educate our clients on the evolving world of private capital and showcase great partners and leaders operating in the industry. In this case, we will focus on private debt. Joining me today to help host is Nicola's head of private debt, Jurgen Van Vuuren. Welcome to Jurgen. We are delighted to also be joined by our special guest, Howard Widra, a partner at Apollo and the head of direct originations at MidCap Financial, a private debt solutions business that Howard helped co-found. Howard, welcome. And what city are you calling in from today?
I'm in Bethesda, Maryland, right outside DC.
Oh, terrific. Well, thank you again for joining. So to get these going, I always like to start with an icebreaker. In our case, given where you went to undergrad, I'm assuming you're a Michigan Wolverines fan.
I am.
Okay.
Yes, very much so.
Pretty safe bet. But
Yes.
pure coincidence and sorry, I'm a Notre Dame fan, and Jurgen's wife is a Buckeyes fan. So firstly, congratulations on the great year. And we want you to help settle us a bet, though, which is, what's a better rivalry for your team and why? Notre Dame with our latest quarterback recruit, Riley Leonard, or Ohio? Who's going to win it all in January 2025?
Well, definitely. I mean, the bigger rivalry now is Ohio State. When I went there, centuries ago, it was probably pretty equal because we were playing Notre Dame every year, and it's, regionally a rivalry, and also sort of, I think people view it academically as a rivalry as well. But that's, for anybody under 40, I think it's all the Buckeyes. And unfortunately, the Buckeyes wrote some big checks this year, so they have a pretty good team. So we'll see. I mean, Michigan did everything on the up and up, honestly, without paying anybody and stealing any signs. And so, we won our championship. So I think the Buckeyes, although from what I understand in the new college football playoff, Notre Dame almost will, gets in automatically. So it'll be a good time for both of them.
I sure hope so. Well, go blue until then. We'll hope that Notre Dame kind of turns it around. It's been too many years of pain for me, to be honest. So Why don't we just kickstart into some of the questions, Howard? Can you give listeners a quick overview of MidCap Financial and your role within the firm?
Sure. MidCap is a, broad-based commercial finance company providing senior debt across like a range of products in the broadly defined middle market. So we do a leverage lending to sponsor-backed companies. We do asset-based lending, receivables and inventory to healthcare companies and, general corporate companies. We do life sciences lending, lender finance, franchise finance. So what you would think of as sort of like a commercial finance supermarket like CIT or GE Capital or Heller used to be 30 or 40 years ago. There's not that many companies out there like that anymore who do it that way, but that's what the MidCap business is. But MidCap is managed by Apollo. So I started MidCap 15 years ago with 5 partners, and then we were purchased by an Apollo affiliate 5 years after, 10 years ago. And we became effectively the senior debt offering for Apollo. So Apollo does most of its middle market senior lending through MidCap. And because private credit has grown so much during that time period, my role in sort of overseeing MidCap has also sort of expanded generally to direct origination and private credit at Apollo. So I oversee MidCap, which is sort of the core direct lending business of Apollo, but there's also a lot of other direct lending private credit businesses as well.
Howard, can you maybe touch on how MidCap interfaces with the former Apollo BDC now, which is now the MidCap BDC as well?
Yeah, so there's an Apollo public BDC, which was previously called Apollo Investment Corp. Its symbol was AINV, which did a lot of sort of opportunistic lending, as BDCs tended to do, from 2004, when it was formed. It was actually the first public BDC until like 2016. When I became responsible for it, and sort of the strategy changed to really become a public vehicle that takes some of MidCap's origination, mostly for its sponsor business. So we renamed it at some point during the last few years to MidCap Financial Investment Corp, which sort of describes more of its asset class. And now it is a public vehicle that owns senior loans only. It still has some older investments that it's still working off that MidCap also originates as well. So it's sort of a way for retail investors to get access to some parts of what MidCap does.
That's great.
What were some of your challenges in creating the business, Howard, back in 2008?
Well, so when we were out raising capital, right, we actually closed on our equity investment the day Lehman failed. So, obviously it's a challenging environment at the time for finance, but it's actually the best time to start a finance company, which is at the bottom of the cycle if you can get someone to support the company. We had a real advantage in building our business because we actually started, the first day we started business with 27 people, 24 of them, we had all worked together at our previous two places, Merrill Lynch, where we had bought a business, Heller prior to that. And so people sort of viewed us as a restart as opposed to a startup. It didn't feel like there was a lot of execution risk if we could get the capital side of the business right, I think, to investors and really to us as well. We were comfortable with each other and knew our roles, and sort of that was really helpful. But then upon raising the equity, it was a real challenge to get debt capital, which is rarely the problem for finance companies for the first 18 months. And we were just fortunate in that Wells Fargo had given us sort of a soft commitment, not a legal commitment, to sort of support the business as we were raising the money. And even as the market got worse, they lived up to that. And so we were able to have some debt capital and build the core of the business. And the market started to recover in late 2009. So it was really like the biggest challenge to our business was getting enough debt capital in order to be able to do the type of lending we wanted, which was not, high yield and risky, but sort of, stable and senior, maybe, just outside what banks were doing. But I mean, our senior team, which is still all together now, 15 years later from starting, was sort of, was our biggest strength, and it still is our biggest strength, like lots of continuity in our group.
It's amazing the pedigree of the teams that were at those predecessor shops and where they've all spun out into. And obviously, you guys have created a great business in MidCap. Maybe let's kind of hone in on MidCap for a second. How do you differentiate what you do at MidCap with other private credit lenders out in the marketplace? Like, what's kind of driving your success?
So a couple things. First, I mean, it's been a great time for private credit. There's been a lot of growth. There hasn't really been a credit cycle in the last 10 or 15 years. So lots of people have been successful. But with that said, obviously we've grown a lot. I think we have a couple nice advantages. One is that we have a lot of products. So there aren't that many product vehicles. A lot of people raise money through their funds, or even at BDCs, they do one thing. And because we do a lot of things, we've diversified away a bunch of the risk of our performance. We have a lot of levers in terms of how we grow. We can accentuate certain products depending on where the markets are. ABL in some markets, leverage lending in other markets. It also gives us a lot of levers to our performance. It allows us to diversify our liability structure because we're borrowing against a lot of different types of assets. And that is a real strength from an equity investor's perspective, a real strength of our business, and adds more stability. The other thing I would say is, and I think this, because the credit cycle hasn't sort of occurred, the strength of this hasn't proven out, but, we're very disciplined on our portfolio makeup, diversified by product and by hold size and by geography and by asset class. And I think, because private credit has become so popular, so many people have entered the space, and I don't think have as much discipline in building the business. You mentioned before, a lot of these predecessor places having spun off a bunch of places. So a lot of the big lenders come from Heller initially, and you see a similar way to doing business to what I just described. And then you'll see a whole nother set of private lenders that have launched in the last 5 or 7 years that come out of leveraged loan desks of Wall Street, which have a different approach. They were agents before. They're more comfortable with different sets of risks. They didn't grow up with the same, thoughts on portfolio discipline. I think that's a real advantage to our platform. and it may be under sort of appreciated until there's a credit cycle. But we sort of believe that it's stability is the calling card of our whole platform, and we try to build our whole business around that.
Well, I guess the next couple of years is really going to perhaps show some of the differences between these different lending kind of perspectives and approaches and hopefully that will help separate the great groups like yourself and with others. Maybe let's jump a little bit into the market. A lot of capital been raised in private debt that you referenced. It's something like 200 billion has been raised in 2023 and just seems like a lot. What's driving the growth in private credit?
I mean, first and foremost, driving the growth is sort of the performance of the asset class over the last 10 years. It's outperformed most everything from a return perspective without any mark-to-market volatility. So, because private credit doesn't have liquid marks, it doesn't move so widely. So you get your steady return. And in fact, it's been an upward return because credit's been good and interest rates are going up. And, it provides a lot of stability. And so there's been just a lot of demand for the asset class. At the same time, it's a growing market. I mean, it's sort of interrelated, chicken and egg thing. So both ends of its market, because banks are not lending as aggressively coming out of the great financial crisis, they were regulated more heavily. And now with the Silicon Valley Bank issues a year ago, the amount of the market taken up by banks on pure lending has shrunk. And at the same token, private credit has grown and taken significant amount of market from the capital markets for broadly syndicated loans. And so there is a significantly growing pie. So sort of demand and supply are both increasing. So that is creating, there's a real secular change, which is sustainable, it seems. That said, it may be that more capital is being raised than even can be absorbed by those changes, certainly at given periods of time. And so it is a competitive market. One thing I would point out is that when people talk about private credit, and certainly when you read articles and sort of the financial press, it generally focuses on leverage lending, loans to sponsor buyouts. And that has gone in private credit from over the last 10 years, from roughly $100 billion market to $1.5 trillion market.
Yeah.
But we define, at Apollo, the private credit market as 40 trillion. So what's the difference? The difference is not leverage lending, asset-based lending, royalties, rail car, royalties, anything. And capital is being raised in all of those markets, but in a less sort of linear, obvious way, because it's harder to enter those markets. And so the private credit opportunity, I think, will continue to expand and capital will be raised. And as you see people raise capital, you start to see some of these more robust platforms diversify their asset classes as well. And it's probably the thing that Apollo has done most aggressively, just a lot of different tentacles into markets that are less penetrated.
Interesting. I think I just read something on Preqin where they're talking about the growth of the market, and they were absolutely identifying what you reference, which is 1.5 trillion growing to 3 trillion, but it's just like a tiny piece of the overall market. Yet they were referencing it as if that was the market. So I think there is some misconceptions out there, as you identified. Jurgen, maybe just you're based in Canada, Jurgen, but obviously a lot of what you do invest in is in the US, but is there a Canadian lens to what Howard's just been talking about and how the market's been evolving?
Absolutely. It's really interesting to see the difference between the US and Canada. I mean, the US is a very fragmented market, obviously much bigger. I think private lenders are generally much more active because banks in the US don't carry as much risk on their balance sheets as they used to pre-financial crisis. Where in the Canadian market, at least for direct lending, that's primarily still a bank market. And Howard will tell you, MidCap has done transactions in Canada as well. They finance some great businesses here, but you're competing pretty heavily in the Canadian market with the banks relative to what you would see in the US. I think because it's a smaller market, we have a bit of an oligopolistic banking market, if you will, and they still have appetite to carry some risk on their balance sheet. So it's very different, and it's meant that we focused most of our time from an investing perspective in private credit on the US market. It's about 95% of our portfolio today, just because the opportunity set's so much more robust.
Interesting. Now, perhaps to help educate some of our listeners, why would a private equity sponsor, as an example, choose a private lender versus a bank? Getting that the banking market is changing, much fewer regional banks than existed historically. But if given a choice, what would make it attractive to go to a private credit provider rather than a bank?
Well, in the US, effectively any deal that has more than 4 times leverage, debt to EBITDA, is a classified asset. and sponsors want to leverage their deals almost always more than that. So that it's almost definitional in many cases. There are some banks that have created some capability to do more of that or willing to take the capital charges in certain cases, but by and large not. So that's one. And then the other reason, which is more recent, the last 4 or 5 years, is that these private lenders are now much bigger. And so sponsors, if they want more certainty, they can come to someone like Apollo or Blackstone or Ares and say, I want to borrow $500 million. Will you lend that to me between you and all your affiliates? And we will be able to do that. Whereas, there's pretty much no bank that can do that. So it's both scale and then the other traditional thing that, non-banks say, which is true, is more facile, decide quicker, easier to deal with, less regimented. But, if you're a private equity firm and you want to borrow less than 4 times and you have a stable business, you will borrow from a bank. But that's generally not what private equity firms do.
Yeah.
And Rob, I think Howard touched on a good point too, is that the private credit market is now financing much bigger businesses than they have historically. So it's not uncommon for a business with more than $1 billion in annual revenue to be financed in the private credit market. So I think for people looking in at the private credit asset class, a lot of people have thought that, they're financing really small companies and that the banks won't finance, but that's certainly not the case anymore.
Interesting. I noticed that over half the capital raised, and again, was described as capital we have to kind of come back to, but was raised by the largest 10 groups, private credit groups in the country. It sounds like, and I'm interested though in your view, is that a good thing that we're getting greater concentration? Is that necessary to support the private equity funds in larger and larger deals, or does that concentration bother you in any way? And perhaps it's just a 1-year thing. I don't know.
The market does not feel that concentrated. It feels very competitive because although those numbers are right, the biggest firms are raising the most money. Because the overall pool is increasing so much, a lot of smaller firms are raising a lot more money than they used to raise before as well. So if we see a deal that is a company has $25 million of EBITDA and is borrowing $125 million, we will have 40 competitors. If there's a deal that's borrowing $500 million, is 4 times that size, we will have 10 competitors. So that's, in some ways, it's a more stable market. It's better for us, right? But there's plenty of competition at the lower end of the markets, even though those are smaller companies. The anomaly is, behavior starts to become irresponsible in terms of, what people are willing to do. So if you ask me, outside looking in, not as a lender, what's the sweet spot of sort of stability where people are lending responsibly and not looking, I think there's plenty of competition. If there were 3, I'd tell you, yeah, there's lots of market power, but there's not. And there's a lot pushing up every day. So I think the markets, there are plenty of competitors on the biggest side of the market. And look, there's lots of regulatory costs to raising these big pools of capital. You raise them retail. So there is some barriers. There's only so many people who are going to be able to do it. So there's an inherent concentration that is going to occur because of the cost related to doing this the right way. So I don't think it's inherently a bad thing of where it is right now. I think there's plenty of, groups with enough scale to keep competition in the market.
Terrific. Thank you. One of the things we've read a lot is it's the golden age of private credit. I think we've heard this term in a bunch of different contexts. Would you agree with that? And if so, what's making it a golden age for private credit?
I would agree with it. I used to joke, when we were a private lender, we were the lowest people on the financial totem pole if you were at a cocktail party. And now we're just wait long enough. And now everybody wants to be, in private credit. And you can feel that, honestly, even in sort of anecdotal ways in terms of sort of what you do. And you also see it in the ways that people are redefining what they say they did in their careers to say they now do private credit. So from that perspective, it is a golden age in that way, and that people want to be in it. And it's also there because of the reasons I said before. The growth in the market is huge. And if you compare it to other areas of finance, whether it's distressed investing, it's private equity for sure, there's just not a lot of headwinds to its overall growth. And it's because, the challenges in the banking system and the advantages of private credit over the capital markets. It's more predictable, more available, less regimented. It's not as cheap as either of those 2 options, but that's it. And people are unlocking capital pools that allow you to continue to grow. So there's more retail money being raised, mostly in non-traded BDCs. There's insurance capital that is, flowing into these asset classes, either through, securitizations or through other arrangements. And so that demand for the assets combined with sort of the competitive alternatives being separated out, it is really a golden age. And you can't, and I don't think you can draw a very conclusive case that it won't continue to grow quite a bit.
Jurgen, you want to jump in on that, particularly from the retail side? Would you kind of make the same comments and from a retail investor's perspective?
I mean, historically, fixed income hasn't been a very exciting place to be, whether it was, I would say on the liquid side, very much not exciting historically. Private credit, you still got pretty differentiated returns even before we had this big rate hiking cycle recently. Now you look at yields in private credit and in liquid fixed income as well. And if you look at it on a 15-year basis, it's sort of top 25% of all-time yields in fixed income, and the spread between private and public credit has held up pretty well too. So I think it's a really compelling time for individual investors to get more exposure to fixed income. I know personally, if I look back at my portfolio, 10 years ago, I didn't have much fixed income exposure because the opportunity wasn't incredibly compelling. Today, you can earn a low teens type of return in fixed income, taking senior debt risk, which I think for a high net worth investor, is a really interesting return profile.
Maybe turning the tables a little bit. If you read any of the newspaper articles on the M&A market, it's down quite a bit. It seems like a lot of people are in the doldrums on where the M&A markets are at. Yet it seems like on the private debt side, you guys are quite busy. Like, is it changing what you're doing, where you're focused, given the change in the M&A market? Or is it kind of just continue to do what you've been doing the last several years?
Activity has been slower in the private debt markets over the last, 6 or 9 months than it was, prior, because, there's less activity. And combined with the sort of the money being raised, there's more competition in every deal, and actually pricing is coming in and activity is a little lower for people. Again, like for us, having diversified asset classes, yes, there's more value to be driven off some of the, the other asset classes, asset-based lending in particular. So we do try to make sure that, we're as aggressive as possible in the areas where there's a little bit more greenfield to go. But, the sponsor lending business is driven by M&A activity. That said, it was a very slow year of investing in private equity last year. And at some point, there needs to be value unlocked. So, for example, now because the debt markets are becoming more competitive, there are more deals being done. And so there is some more activity, even if there's less M&A, because there's companies looking to, sponsors looking to generate some returns that way. So the money finds a way to get invested. And sort of that's happening a little bit, but our market does move with the M&A volume, and our market is down a little bit. And you would hear that like from public calls for public BDC vehicles, everybody saying, the flow is a little slower.
Yeah. Jurgen, have you stayed busy, the slowing M&A market and private debt?
Yeah, I mean, I think we've been fortunate to have partners like MidCap that have a pretty scaled business and continue to show us more investment opportunities. We work with multiple partners, and so I think that's helped us to continue to see pretty active deal flow. I think today, if you have a big portfolio of existing borrowers, there's still a lot of activity there. Well, they'll do tuck-in acquisitions, and most of the slowness is in brand new buyouts for private equity sponsors when they're buying a new platform investment. So hopefully, we see private equity start to deploy capital again this year. I think we're in month 15 or 16 of sort of the M&A slowdown here. And typically they last about 18 months or so. So hopefully we're in the last innings of the M&A slowdown.
Howard, you mentioned there's several subsectors of private debt, private capital, or sort of the private debt arena. Could you touch on some of the areas you think are going to be most compelling for the rest of 2024? Is there some areas that you'd say we're going to vector a little bit more that way because of where the markets are at?
Well, the flavor of the year that a lot of the big asset managers are marketing, including Apollo, is what, they're calling it asset-based finance. In our business at MidCap, asset-based lending is lending against current assets, receivables, and inventory. That's always been a good business. It takes a lot of sort of people and systems to do. So mostly what people are referring to asset-based finance are more sort of hard collateral, either equipment or lending against, pools of loans, that other people have. So someone will have, like, for example, a pool of aircraft loans and lending against some tranche of that. So you're covered by assets, if you will, as opposed to covered by cash flow. And those deals are private in that, they're not QSIPs that people can go buy out there. So that is sort of the biggest asset class that not only you'll see big firms raising large pools of money, but also see being offered retail soon, if not yet, for a lot of people to be able to get access to. Very broadly defined. It really is, depending on who is the manager, but it really means lending at some level in the capital structure against something that if it's worth what you think it's worth, you would get paid out even if things go wrong. At Apollo, there's some big asset classes that, we are focused on growing. Something we call securitized products, which is the senior lender to, people who are gathering assets, whether they're consumer or real estate or commercial, where the bank market has stepped away from. So there's a really big business called Atlas that Apollo bought out of Credit Suisse, which is growing a lot. So that's a really big business. And, we have an aircraft business, an equipment business, and a trade finance business. And so like all of these asset classes that are, have traditionally been banked well, but maybe are banked less, we're expanding into and, have good size to them.
Jurgen, how about you? Some areas that you're focusing on?
I mean, our core strategy is still U.S. middle market direct lending, and MidCap's a key partner for us there. I think we're looking at a couple of other things. One is credit secondaries. We've seen some pretty interesting opportunities where you can buy on a secondary basis either an LP stake from another institutional investor, and that's as a function of some institutions just being overweight private markets because public markets have been fairly volatile. And NAV lending is another area that we're looking as well, where you're actually lending to a private equity fund that owns a portfolio of mature assets. And so your collateral is effectively that, the equity that's in that portfolio underneath the private equity fund as a space that we're looking into as well. But I think we've looked at the US middle market opportunity on a senior secured basis as being really attractive for our clients. You can earn kind of a low teens type of yield. That's been where we've spent most of our time is senior secured land.
So one of the areas I'm intrigued about that hadn't been getting a lot of attention more recently is the beginning of private debt is the mezzanine area. There's a lot of capital that's been raised over the last 24 months in that area. Is that something that's interesting, or what's your view on mezzanine debt generally? Is there a resurgence going on for that form of the capital stack?
Well, mezzanine debt is either equity risk with debt returns or it's debt risk with equity returns, depending on if you raise the money or not. I'm a senior debt person, so I always I tend to be, debt focused. But mezzanine debt has not really had, a real renaissance yet from when it sort of dipped down a while ago. If only because, or mostly because, there's a lot of unitranche lending by the senior lenders. So there's lots of options from the senior lenders to go all the way through the capital structure. And so there's just the opportunities are less. It's not as sort of large and robust a market. But, certainly you definitely see it from time to time on transactions where where a sponsor decides to take less debt and take on some mezzanine, instead, and they get two lenders in the capital structure. So no, it is not like a huge booming market because of that senior debt component where the senior debt is sort of sucking up a bunch of the opportunities. Leverage is lower now because rates are higher. So you can attach at lower points from a mezzanine perspective. Interest coverage is worse, but it's still if interest rates go down, you're going to end up in a good spot. So from an investing standpoint, this isn't a terrible vintage to be a mezzanine lender, but I still think it's sort of an anecdotal market.
Jurgen, how about in Canada with the market? You described earlier the market's a little bit different here with the banks controlling much more of the market, so they're doing most of the senior debt. Is there a bigger opportunity for mezzanine in Canada because of that, or not so?
It's been very episodic. So when COVID happened, there was this big narrative out there that the banks are completely on pause, and so it's going to create a great opportunity for mezz lenders to finance fantastic companies who can't get bank financing. And that window has historically been pretty short. So the banks in Canada might be out of the market or slow down their lending for 3 to 6 months. They're still supporting their existing borrowers, but their loan growth is maybe just a little bit slower. But then after that 6-month period is over, they come roaring back and they're happy to lend again. And so then the mezz opportunity becomes very thin. And so, I think mezz can be interesting on a very company specific basis. To Howard's point, most of the mezz opportunities that we see, they're really equity risk dressed up as debt. And so we avoid those. But from time to time, we will see a mezz opportunity that we'll pursue.
Howard, back to you on kind of the broader public, that is the retail side of things. Do you see them continuing to increase their share and allocation towards private debt? Is it just something we've seen in the last little while, or is that kind of a longer term trend that you guys are jumping on? And I know you have, that there's an area that's important to you, but I wonder what you think about where that market's going.
I do think it'll grow a lot. So if you think about it, like the whole ecosystem, prior to this private credit accessing retail, the way people got fixed income exposure outside government bonds is through mutual funds. So there's huge dollars, invested in this category. It's just all through mutual funds. So if you just take a small percentage of those dollars and they move into these assets, it's not even close to sort of, percentage points penetrated. There'll be a lot of money move over there. And in fact, one of the trends that you'll see, which I think underscores what I'm saying, is that all the big mutual fund companies, Fidelity, Vanguard, BlackRock, are launching significant private credit businesses because they have to offer that to their retail clients to keep them. So it is, I think, very early in the sort of the building of this pool of capital.
Jurgen, anything to add? Obviously, this is where Nicola Wealth's capital is coming from that's supporting you in your private debt area.
Yeah, I mean, we've seen pretty significant amounts of capital raised from the high net worth channel for private credit for various managers as well. I think one of the challenges, especially in Canada, has been for high net worth investors to differentiate between what is a high quality manager and maybe a manager that's taking too much risk. Because on the face of it, if you look at just the returns in a period where defaults have been pretty low, they may look fairly comparable. But once you actually get under the hood and if you have the ability to underwrite the individual credits, the risk profile starts looking significantly different. And I think the performance is going to look a lot different too if we do go through a cycle and if defaults do start to get higher. And so I think that's going to be a big challenge for high net worth investors is how do you figure out who are the managers that you want to be partnered with? And ideally, you've got some expertise that you're leveraging, whether it's from your financial advisor or otherwise, that's helping you do that.
I think that's good advice in the entire private capital area. Maybe we'll finish with top 2 predictions for the private debt landscape for the rest of 2024. Howard, why don't we begin with you?
I think first, I'll get more attention at cocktail parties.
You already get lots of attention, Howard, I'm sure.
For a little while. And then, I guess I think my prediction would be, and this is unusual for me because I've said I felt like, so maybe I've been wrong for the last decade, which was that we've been preparing for a credit cycle, for a long time and expecting some of that shakeout to occur. And I'm not so sure it's coming in the immediate future. It feels like that, the Fed will prevent it as much as it could prevent it and remain sort of like accommodative such that like a recession doesn't occur and then people don't feel. So my prediction would be probably a little bit more benign than it looks like it should be based on sort of the length of the lack of pain as well as sort of, some crosswinds in the economy. So I think we've got some runway in the medium term right now for it to remain normalized. And this is coming from someone who would be fine with the credit cycle because I think we've teed our business up as best as we possibly can to, absorb it.
Jurgen, I'll give you the last words.
I'm going to say the Fed funds rate stays above 5% through the end of the year.
Interesting.
I think Apollo's chief economist just came out with a similar view I saw this morning. So
he did say that. Yes. Yeah.
Great. Well, terrific dialogue, guys. I think we've kind of covered a bunch of different parts of the landscape. And I think we're pretty much at time. So Howard, thanks again for making yourself available and your insightful comments. It's been great having you as part of this podcast. And Jurgen, of course, thanks to you for helping to co-host.
No, thanks. It was fun anytime. And hopefully I'm not one of one.
You got to help us come up with a name. We were thinking 9 rounds with Rob because Rob used to be an internationally ranked boxer. So,
yeah, that's pretty good.
Yeah, it helps in the private debt arena when you have to.
15 rounds. It used to be 15 rounds.
It should be 15 rounds. Yeah, I don't know where 9 came from, but yeah. I think it's we only had 9 months we were going to get these finished as we went with 9.
Yeah.
We're only starting now and we have 9 months for the year. We really do appreciate it. And thanks for making the time.
Thank you.
Okay, thanks. And thanks to each of you for joining our podcast on private debt. And keep an eye out for our next podcast, which will dig into the evolving world of private equity. Until then, cheers.
Thank you for listening to another episode of The Wealth Exchange. You can view today's show notes and subscribe to the podcast on our website at nicolawealth.com/The Wealth Exchange. Some of the companies or securities mentioned during this episode may be held at the time of recording by Nicola Wealth. Please view the show notes for full disclosure of our position in these companies. This podcast contains the current opinions of the presenter, and such opinions are subject to change without notice. This material is distributed for informational purposes only and is not intended to provide legal, accounting, tax, or specific investment advice. Please speak to your Nicola Wealth advisor for advice based on your unique circumstances. Forecasts, estimates, and certain information contained herein are based upon proprietary research and should not be considered as investment advice or a recommendation of any particular security, strategy, or investment product. Nicola Wealth funds and limited partnership returns are net of fund expenses charged to date. Any discussion of past performance is not indicative of future results. All investments contain risk and may gain or lose value. Projected returns are estimates only. Returns are not guaranteed. This is not a sales solicitation. This investment is intended for tax residents of Canada who are accredited investors. Residency restrictions apply. Please read the relevant documentation for additional details and important disclosure information, including terms of redemption and limited liquidity. Nicola Wealth Management Limited, Nicola Wealth, is registered as a portfolio manager, exempt market dealer, and investment fund manager with the required securities commissions.